Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. So I'm going to share right out the gate with this episode that me as a CPA, I'm pretty middle of the road when it comes to conservative versus aggressive. And I think that I'm aggressive within reason. It's like selectively aggressive based on my interpretation of certain tax code. But I want you to understand that if you're listening right now and you've been listening to me or other creators on social media that are talking about taxes, I want you to understand that there's certain nuance and things that you have to read between the lines on. And if you're watching creators right now and you're thinking, well, my CPA said we can't do that, or my CPA said no, my accountant said it wasn't worth it, my accountant said no to doing this, it's for one of two reasons. And it's up to you to discern which one it is. But I think it's one of two reasons. One is straight up, they don't want to do it, AKA they're lazy, AKA they just don't want to do it for you. And they don't really need an excuse to not want to do it. I just wish they were more honest with that answer and saying, you know what, it might be a good strategy for you, but I'm really not offering that as a service. I think that they're too afraid to be running their restaurant, have you order something they don't serve, and then being disappointed when you go across the street to go eat it. They just want to keep you in their restaurant. So they're like, yeah, I don't think we should do that. And they're trying to keep you where you are and not allow you to maximize that strategy. Now, is that selfish? Somewhat, yes. But if that's their business model and that's how they want to run their business, who am I to judge? Now, let me get to the real reason that most accountants are going to tell you no. And that's because it's not worth it. The problem is they don't do a great job of explaining that. And they don't do a great job of explaining why it's not worth it. Typically, it's because they're in such a damn rush that they don't take the time to really explain it to you or sit down with you or call you and explain it. So because they won't, I'm going to do it right now and explain to you why certain tax strategies, especially those that are being shared on social media, are typically not worth it. So let me start with the one that's most prominent in my mind, which is hiring your kids. So hiring your kids, you're going to hear, you can pay your kid up to $13,850 a year tax-free. Yes, you can. Okay, yes, you can. But here are the facts. Number one, you have to pay the kid for the work that their skill set gets paid. So if you're talking about a 6-year-old, it's highly unlikely that you can justify near 14 grand of fees to the 6-year-old. Like, what are they doing? What type of work are they doing? They're not exactly doing clerical work or making phone calls or driving you around or setting up all your stuff. Like, you have to look at their actual skill set of what they could get paid in the market if they were allowed to work anywhere else. And typically, I would say below early teenage years or preteen, it's a challenge to find enough work to make this worthwhile. Because let's say you have a 6-year-old and you argue you can pay them, I don't know, even $10 an hour. Let's just use that as an example for easy round numbers. I can pay them $10 an hour to do certain tasks for me. Okay, but how many hours a week can they legitimately work? Say they can work 4 hours a week. Well, that would be 4 hours times $10, so $40 a week, times, say, I'll just say there's 5 weeks in a month for easy math. So again, if there's 4 hours a week at $10, so $40 a week times 5 weeks is $200. So $200 a month, which equals $2,400 in a year. So that's how much you're going to pay them. Not 14 grand, but close to like 2 grand. And so then if you think about it, you have to go set up a separate bank account for them. You have to put them on payroll, which costs you, maybe 12 to 15 bucks a month on Gusto, then you have to, give them a job description, a job agreement, document everything, have them track their time. By the time all of that's really done the right way, when you think about it, if you're deducting, say, $2,000 for the whole year for the kid, you're really saving, like, I would say optimistically, you're saving 40 bucks in taxes. Or sorry, no, $400. I'm missing a zero. If you're deducting $2,000, take 20% of that or so. And that's like the real tax savings. So ballpark, I'm just using rough napkin math here, guys. But if you're only saving a couple $100, but it's going to take you like 8 hours to set up this whole strategy, it ain't worth it. So for the most part, most accountants have done this math. Most accountants have figured this out, and they're going to tell you it ain't worth it. But they're not going to do the math for you and explain it, which I think they should. I do. I think they should, just to explain it to you. But at the end of the day, just understand that if the child is under a certain age, inherently the accountant is going to say, no, not worth it, not worth it. But it's not to brush you off. And it doesn't mean you should go with somebody else necessarily. I just think you need to poke them a little bit more and have them explain why. So in that particular situation, very often, hiring your kid is not lucrative unless the kid can do high-level work that's valuable and work a lot of hours, in which case the $14,000 becomes way more accessible. It's worth setting up all of the tools in place. It's worth having them do that and set aside some in their Roth IRA, which would be amazing. That is maximizing the strategy, and I'm not discouraging you from doing it. But I am telling you that unless your kid can justify the hours and the type of work that they're doing, then it's not going to fly in an audit and it may not be worthwhile. So just understand that one might be tricky. The other one is Augusta rule. So you may have heard this thing where you can deduct, or you could rent your home, like your business can rent your home from you for up to 14 days. Yes, it can. However, it's not like you don't get to set a massive rent total or anything like that. It's up to 14 days. You have to justify why there's a business purpose to this rental, and it's definitely hard to implement. You have to have a rental agreement. You have to be able to prove that meetings were held in your home. You have to prove the use of the home. And that can be super challenging if you don't already have in your instilled behaviors a use for your home, or you're not already meeting there. If you're just starting to meet there and starting to create these documents as a brand new habit, then it can be a lot to add into your routine. Now, yes, this can be very lucrative, but it's not one of those things that's going to move the needle so much that you're going to really experience a massive increase in tax savings. Because at the end of the day, your deduction is limited by the going rate for a meeting space in your area. So if you live in the Midwest, if you live in a low-cost area, it can be really tricky to save a lot of money with Augusta rule. Now, if you live in Midtown Manhattan, different story, but you have to justify it. So you're really limited by the comparables where you are economically. And you're only going to be able to take a rate of rent that compares with your local area. Yes, you can try to find nicer places, but at the end of the day, sometimes it's just not worth it for all the effort you have to go through to document everything. And that's totally understandable. And lastly, I want to tell you about the S Corporation. Now, I'm a big fan of the S Corporation. I'm a massive S Corp fan. And I advocate for that strategy for a lot of clients. And if you don't know what the S Corp is, we're going to link some of the episodes in the show notes, along with any other episodes related to the strategies I'm mentioning, just so you can understand a bit more detail on how to implement them effectively. But the S Corp is not always a good solution. I'm going to give you a reason why. So with an S Corporation, it's not always the best idea to implement if you can't handle the responsibilities associated with it. And that mostly comes down to record keeping, bookkeeping, and paying yourself payroll. So if you're not ready for these types of responsibilities, then you're not ready for the S Corporation. I would say with great savings comes great responsibility. You need to be documenting your S Corp stuff, documenting your meeting minutes, documenting your payroll, all of that. And if you're not willing to do it, then you're not going to be a compliant S Corp. And you could miss out on other tax savings. You could create issues for yourself down the road. Who knows? And also, here's another thing. Depending on what state you're in, it often doesn't benefit you if you're in certain states in the United States. For example, I'm going to name New Hampshire as one of them because I've seen this happen before. New Hampshire charges a corporate tax, like a pass-through entity tax on S corporations. And it's charged to the point where it counteracts a lot of the savings that you experience on a federal level. So if you're in, say, a state like New Hampshire, and there are other states too, but if you're in one of these states, it actually is worse for you to be an S corp in most situations than if you were not an S corp, than if you stayed in LLC. So if you're seeing this tax advice on social media that you need to go become an S corp, broadly, yeah, this is all true. I've even posted about it. But there is a nuance there to states because your state may not recognize the S corporation and it could do you more harm than good. So before you go try to ask for these strategies to be implemented, before you go seek them out, I would encourage you a simple Google search, even a GPT search if they're up to that point yet, but start somewhere. I'm not saying take it as authority by Googling it or asking ChatGPT, but I'm telling you that a basic level of research on, hey, what are the requirements to do this? Or even reading or listening to the other episodes that I've linked below would give you a little bit more information as to whether this is a good fit for you and worth your time. Your accountant is not necessarily a party pooper. Your accountant is probably looking out for you, but they just haven't quite explained why it doesn't make sense for you, and it doesn't make sense for you right now. I would encourage you, if you're seeing these tax strategies all over the internet, all over social media, understand, yeah, a lot of this stuff is correct. I'm not going to diss on any creator who's sharing this information about tax strategies. But what I want you to know is that it's not universally beneficial for everybody. So it's kind of like diet advice or fitness advice. You can say all day that something's good for you, but you never know who's walking around with an allergy to it. And it would be an exception to that rule. So take it for what it's worth. Understand they're trying to market to you. Understand that social media is a place where they have 30 seconds or 60 seconds to share what they know and to get you curious about taking the next step with them. These are all marketing, ads, campaigns, things that are intentionally trying to get you to take action and book a call. So if you approach it like that and you understand that's the objective, walk in feeling empowered to understand that you're in control of figuring out whether this will apply to you and getting the right advice to make sure that you're taking the right steps. So just understand there is a truth behind all these strategies, and it's not always the sexiest thing, but if you definitely look at it objectively, you'll be better off in the long run. Hey, I'm so happy that you're enjoying daily episodes of the show. And if you want more bite-sized tips from me based on what I'm discussing with my clients and my team, text me the word daily to 860-609-6374, and I'll share daily tips to help get you into the CEO mindset, and we can chat about how to implement them in your business. Again, that's the word daily to 860-609-6374. Want a little bit less than daily? Well, you can also text me the word weekly, and you'll just get my Monday messages. Again, the number is 860-609-6374. Shoot me a message anytime. I cannot wait to chat with you.